Okay, so we're going to now talk about the idea of proving the concept that we have with the premium selling techniques, as well as the idea of using trend following methods to help us time when we want to be playing offense and when we want to be playing defense in our portfolio. And so what we're going to do is we're going to use a technique called back testing, and all that does is we're going to take historical data and we're going to apply a system to that historical data to see whether it would have given us some kind of advantage in the past. And what we're going to look at is a moving average crossover system, and we're going to use weekly bars as opposed to daily bars. And we're going to test it from January 2001, so the beginning of 2001, through May 20, 2011. All right, so that's the basic parameters of the test. We're going to use $100,000 starting capital, so assume you had an investment account with $100,000 in it. And we're going to allocate 100% of the capital, so there will be no portion of that $100,000 left in cash. All right, so we can't buy the S&P 500. It doesn't exist. It's a hypothetical index. What we're going to use instead of the S&P 500 are shares of the SPDR. So we're just going to buy SPDR shares. But for backtesting purposes, it's not going to really work because options did not start trading on the SPDR until 2005. So even though we could buy the SPDR and backtest the buy and hold concept, we can't backtest the covered call concept because those options were not available for half of the time we wanted to be involved in the backtesting. What I ended up doing was settling on shares of IBM. It's an individual stock, but it tends to be a very good investment quality stock. It's a member of the Dow Jones Industrial Average, and it substantially outperformed the S&P 500 from 2001 through 2011. So this is what we would consider, a good stock, something that you might want to own as part of an equity portfolio. And for purposes of demonstrating the concept, I think it's a good place to start. Although, before you start using techniques like this yourself in your portfolio, at least on a larger scale, you're going to want to test more than just IBM. So here's IBM versus the SPDR. The SPDR is the red line. Okay, and you can see that the IBM stock outperformed the SPDR for the majority of time from 2001 till mid part of 2011. In other words, given a choice between the two of those investments, you're probably going to want to own IBM. IBM yielded 74.5% from 2001 to May 17, 2000. It's April 4th, 2011. So we had a 74.5% yield, and if you remember, the SPDR was minuscule. It was like 8% over that period of time. So about 75% return over 9 years and 5 months, or roughly an 8% annualized return, which is pretty good. Max drawdown was 33%. All right, so you make note of those figures because we're going to compare the performance of the buy and hold approach to our model, our testing model. All right, so what we're going to test here is what I call a modulated covered call, and the the test assumes that we're always in the market. In other words, we're never getting out of the market. We're always long IBM. During a bullish phase, we're going to sell at the money calls. And then during a bearish phase, what we're going to do is we're going to move to an in the money call option. In other words, we're going to sell an option that's a strike in the money to give us a little bit more protection against downside movement. So our original investment was $100,000, and the ending value at the end of the test was $229,000 and change. It's almost $230,000. Our lowest value during the test was $97,000. So we did have an account drawdown that took us down about $3,000, $2,800 less than our starting capital. Our highest value was our ending value, which was the $229,000. Our max drawdown at any period of time was 27%, which is roughly a 27.2% max drawdown. Our return was 130%. Our annualized return was 12.5%. So when we compare the buy and hold versus the modulated covered call, what we get is an annualized return on the buy and hold of 8%, an annualized return on the modulated covered call of 12.5%. Our max drawdown on the buy and hold is 33%. Our max drawdown on the covered call is 27.2%. So by using this modulated covered call approach, we improved upon the annualized return. We also improved though on the drawdown. And again, this is always in the market. So we're getting better yields, and we're experiencing less volatility in the account. Now this is the same test, but we're going to use what I called a modulated collar. And the rules again are we're always in the market. In the bull phase, we're going to sell an at the money call, but in the bear phase, what we're going to do is we're going to shift to basically a collar by selling either an at the money or in the money call option, and then buying an out of the money put option. All right, we started out with $100,000 in capital, ending value $211,000. Our lowest value was $100,000, so we never dipped below our starting capital. Our starting capital was safe at every step of the way. Highest value was the ending value. Our max drawdown during the test was $13,000, or about 13.1%. Our maximum return, or our total return, was 111%. Annualized, 10.7%. So we compare the modulated collar, and we're still beating the buy and hold on a yield basis, right? 10.7% versus 8%. But our max drawdown is almost a third of what the buy and hold was. All right, we're at 13% instead of 33%. So we really, really improved on the volatility, a much less volatile portfolio. And it beat the buy and hold. So what we're doing, we're not stock picking. I mean, we're using a good stock, but we're not out there churning the portfolio in the sense of like jumping from one stock to the next stock. We're always in the same vehicle. All we did was change our strategy. And we didn't change the strategy midstream. We started out with a set of rules, and we applied it, over time. So right here you've got three different approaches to a long-term investment strategy. And some people might look at it and say, you know what, I'm all about the yield. And if the modulated covered call has the best yield, that's for me. Others might say, you know what, I'm all about the drawdown. I don't want to experience any drawdowns. I'm 5 years away from retirement. I don't want to muck it up. I'm going modulated covered call. Okay, so again, this is one strategy using a moving average crossover system that we back tested. So we're going to get a little unconventional now when we start thinking about covered right strategies. And it's okay to be unconventional. It's okay to say, you know what, I'm going to do things a little bit differently than everybody else. Okay, everybody else is telling me forget about these options. Forget about all of this risky stuff. Just put your money into a good mutual fund and then forget about it for the next 20 years. But I'm going to take a different path, or at least I'm going to take a look at a different path. So we're going to start, and I always like to start with a strategic perspective. In other words, let's figure out what we're trying to accomplish, and start separating the theories that have demonstrated some potential merit versus those that don't. So thus far in the presentation, what we've done is we've compared a traditional long-term equity portfolio to different covered right approaches. We looked at the buy right index, which is the BXM index, selling at the money calls month after month after month with no regard for what's going on in the market. Just buy the index, sell the calls. We looked at the BXY, 2% out of the money. We're still selling calls. They're just a strike or two out of the money. We looked at a collar index, and we looked at the put right index. And what we saw out of that whole series was the put right index provided not only better yields, it also provided the lowest volatility, the least amount of volatility. So we've looked at the benefits as well as limitations of technical trading systems, whether you're using a moving average or a moving average crossover system. These are trend following systems. And the weakness of a trend following system is, number one, it's not going to put you in at the bottom of a market, and it's not going to take you out at the top of the market. So you're going to be a little bit late to the party, and you're going to be a little bit late leaving. But it's going to spare you the worst of the market sell-off, and it's going to put you in for most of the upward trend. The other weakness of a trend following system is that you're going to be prone to getting whipsawed during market consolidations. The shorter your moving averages that you're using, the more often you're going to get whipsawed. But you'll get in faster and you'll get out faster. But you're going to have to live through more whipsaws. If you want fewer whipsaws, maybe you lengthen the amount, the length of your moving averages. So instead of using a 20 and 50 day moving average crossover, maybe use a 5200 day moving average crossover, or maybe use 5100. Which one do you want to use? Well, you're going to have to spend some time back testing it. But what you're going to experience from a reasonably sound trend following approach is that when the market does enter a trend, you're going to be on the right side of the trend. And when that trend concludes, and they always do, and when it comes to an end, it's going to take you out. and the most frustrating aspect of a trend following system are the whipsaws that you experience during consolidations. Right. We also looked at some defensive measures that are intended to protect our capital. And our strategic goal is to maintain a long-term positive delta position while reducing our volatility and hedging against intermediate market declines. So in other words, what we're saying is that we have confidence that over the long term the market will rise. But we're also recognizing that in the short term and in the intermediate term, we will experience market pullbacks, we will experience secular bear markets, we will experience periods of consolidation, and during these periods of time, what we want to avoid having happen is an erosion of our investment capital. So we want to be positive delta because that's where we're going to create most of our wealth. But we want to reduce the amount of volatility in the portfolio because we've seen what volatility does to long-term returns when you cannot compound your earnings. So we want to reduce volatility while maintaining that positive delta, and we want to hedge ourselves against the intermediate market declines. That is the perspective, the strategic perspective we're approaching for purposes of this analysis. So the tools that we have at our disposal are our ability to select good stocks. Right? Now, there's nothing wrong with saying, hey, you know what? I want to use ETFs. I want to do the Spider. I want to do the Diamond. I want to do IWM. I want to do the Qs. That's fine. Now, you do have to stay on top of things, because even though the Spider is based on the S&P 500, you need to be aware of what's going on with it. Okay, so you want to be aware of whether there's any changes coming to the ETF, whether there's going to be a rebalancing, whether there's going to be any kind of distribution. So you need to pay some attention. But you don't need to pay the kind of attention that you do if you're investing in individual stocks. You probably will experience less volatility using the ETF, but you will also probably experience lower yields. The other tools we have, technical and fundamental analysis. We have the ability to do some fundamental analysis to make sure the long-term investments we are purchasing are sound investments. Buy stocks in good companies. What's a good company? Well, to start, you want a company that's profitable. You want a company that's making money. You probably want a company that has reasonable levels of debt. You probably want a company that has a demonstrated ability to grow its earnings. In other words, it's making more money this year than it made last year, and that there's a historical pattern to that effect. You want to take a look at the cash flow of a company. Is the company generating enough cash flow so that it can pay its operating expenses? Because if you don't have enough cash flow to pay your operating expenses, then you don't have a business that's going to be viable very long. And then the last tool we have are long and short options. We have calls and puts, and we can buy them and we can sell them. Right, the covered right strategy suits our strategic long-term view and objectives because we want to be long equity. And the covered right's going to give us a long equity position. It's going to give us that positive delta. And the methodical premium selling helps reduce volatility. So right there, just the selection of the strategy satisfies two of our primary objectives in structuring the portfolio. We want the positive delta bias, and we want reduced volatility. Now, risk management needs to enter the picture so that we can moderate our delta exposure during market, adverse market conditions. When the market turns bearish, we need to be able to step in and either reduce our position size, hedge it, or take some other action to reduce the amount of exposure we have to that market pullback or to that bear market phase or to that market consolidation. So we want to modify our covered right. We're going to take a look at modifying it to still meet our strategic objectives, but to give us a little bit more flexibility. And we can simulate a traditional covered call, but with a smaller capital investment. In other words, we're going to put less money, we're going to risk less money, while still maintaining a similar, although not identical, but a similar overall portfolio structure. And the result is that we have less capital at risk and we have higher potential yields, because our yields are going to, from a dollar perspective, will be similar to what we would get from a covered call, but because we have less capital at risk, the overall yield on your risk capital is higher. What's our drawback? Well, we're going to give up our dividends. So you can factor the dividends into the overall yield structure. And sometimes you're going to say, you know what, I want to own the underlying equity. And that's fine. This is going to be another approach that may make some sense under differing circumstances, though. All right, so we're going to use an in-the-money, high delta, longer-term call option instead of the stock. What this does, because it has a high delta, and when I say a high delta, I mean something with a delta of 0.80 or better. We're going to capture 80+% of all price movement. And even though the option is going to be deep in the money, it still will cost a lot less than owning the stock. And that less costly capital structure means that our yield is going to be higher. And when I say yield, what I mean is our return on risk. So we're back to IBM. But this time, instead of $100,000 of IBM, we're only going to invest $10,000. And we're going to manage our trade from January 2011 until May 2011. So the same time period. And what we're going to do is, instead of buying the stock, we're just going to buy a 6-month call with a 0.85 delta. Now, what about implied volatility? Where does that come into the analysis? And for the testing, we're not going to be worrying about whether vols are high or low when we buy the option. But one of the nice things about buying a deep in the money option is that it has a relatively small exposure to extrinsic value, because most of the option is made up of intrinsic value. In other words, the option is so far in the money that most of the option's value represents the intrinsic value of the option, and there's a relatively small exposure to extrinsic value. Plus, we're going to be selling options against it. So if vols are high, we're going to be selling high front month vol against that limited exposure in the back month option. All right, we're going to sell either an at the money or an in the money front call. So far this is very much like the covered call approach we took with IBM. The only difference is, instead of buying 100 shares of IBM, we're buying a deep in the money call option. All right, so here's a 2011 IBM covered right. And if I remember correctly, this is, if not the same position, it's a similar position to one that I managed in my daughter's education account. And we took an opening trade back here. We wrote it up. We went through a bear phase in the middle here and entered a new bullish phase, at the end of which we closed out the trade. When I say we, I mean me. All right, so this is the portion of the market move that we were involved with. It's obviously an overall bullish move from beginning to end, but it had its volatility. It had its volatile moments. So here's January 3, 2011. Okay, we're looking at buying a July it's going to be an 83.5 delta, which is the 130 call. So we're buying the 130 call with an 83.5 delta. Now, I said we're going to buy an 85 delta. Well, here's the thing. 85 is kind of like this is not precise. If we look at the option chain, we got an 88.2, we got an 83.5, and a 77.4 in July. It's not exactly 85. You're rarely going to have exactly 85 or exactly 90 deltas. If we wanted a 90 delta, we'd be looking at the 120 call, which is 91.5, or the 125 call, which is 88.2. Both are pretty close to 90. Okay, so don't get too hung up on the numbers. The numbers are suggestions. But on the other hand, you don't want to say, well, you want to buy an 85 delta and then go buy the 69.8. Right? You want to be in the ballpark. All right, so what we did is we sold the 150, the Jan 2011 150 call. We bought the 130 call. And it gives us a risk graph that looks similar to, but not exactly, but similar to a covered call. And the benefit of going this way is we're using less capital, which means we have less money at risk. And we're getting a little bit more leverage, meaning that our yields are going to be a little bit better than with a covered call. So you can see down here at the bottom, perhaps, that our maintenance requirement or our capital cost is less than 10 grand. Now, if you try to duplicate this with a covered call, you'd have a lot more money at risk. Going the wrong way. All right, so here we've got graphs for the modified covered right. And this, you're going to hear this called by different names. You're going to hear some people call this a time spread or a diagonal spread. Covered right. They're all describing the same things. There's one term is not better than the other. They're all describing the same thing. The concept here, when I say modified covered right, is that we're using that deep in the money call option, trying to simulate stock, as opposed to doing a time spread or a diagonal spread that's a lot closer to the money. So our cash requirement for the covered call, $73,000. If you're trading on margin, it'd be $36,000. The maximum yield, and this is just for the first month, is between 3 and 5% depending on whether or not you use margin. So maximum margin gives you a 5% yield. Covered right, cash requirement $9,200, $9,300. Max yield 15%. Now, you don't want to get too carried away with the idea that you're making this 15% yield on IBM using the covered right versus the more traditional covered call. This assumes that we've basically got a $10,000 position versus a $100,000 position. So if you have $100,000 in cash to invest, and you do the modified covered right, you probably don't want to take all $100,000 and plunk it down into one of these covered right trades. Whereas you might be willing to put a substantial portion of that into a covered call. But with the covered right, you're using options which provide you with leverage. But the unspoken rule there is that you need to exercise some self-restraint. So either you're going to hold back the rest of the capital in cash, in which case your yield, your portfolio-wide yield, is going to be a lot less than 15%. Or what you're going to do is you're going to take that cash that's not being used for in the IBM investment, and you're going to spread it around someplace else. You're going to put it into some kind of interest-bearing account or bonds, or maybe you buy other types of stocks, or you diversify the portfolio out further. But bear in mind here is, even though we're saying the max yield on this position is 15%, that does not necessarily translate into a portfolio yield of 15%. Bottom line with the modified covered right, less capital, less risk, higher yields. So what we have here is a screenshot of the covered right position. We're now January 19th, I believe. Those Jan front month options are just about ready to expire. And we've made money on this trade. So we're going to have to adjust the trade because we want to stay in it. And our current front month position is now in the money. Our option's in the money. So we're going to have to roll out to February, and we can roll out to the same strike, or perhaps we're going to roll out and up to one strike higher, which would take us at the money. Our back month options are still there, and they're even further in the money. Now, I'm not displaying there the delta. It's showing us the time premium. The time premium on the back month, I think, is about 64 cents. It's pretty minimal. And so by selling these front month options, we're negating our Vega risk because we have very little time premium in that back month. So let's see. Okay, now I switch to delta here. So we're looking at our delta. We've got, I think it's about a 92 delta. So we've increased delta. Now that may seem like a good thing. You might think, yeah, those. Now we're getting 92% of the price move instead of 83%. Well, it cuts both ways. Not only do we get 92% on the upside move, we're going to get 92% on the downside move. In other words, we've increased our delta risk. So when we start looking at modifying the trade position each month, we need to evaluate both the front month and the back month. If we want to return to an original risk profile, in other words, we want to get back to a delta similar to which we started with, we're going to need to move from that 92 delta to a higher strike in the back month. But that's okay, because when we do that, we're going to take a profit by selling that original, probably, I think it was a 130 call, and we're going to roll it up to a 140 call, and that is going to lock in some profit. So we're taking some capital off the table. And it will also help finance any debit we might incur by rolling to a higher strike in the front month. So the adjustment kind of looks like this. We've got to close out our front month Jan strikes, and we're going to roll out and then up one strike in February. We're going to sell our deep in the money IBM 130 calls, and we're going to roll those up same month, but a higher strike. So we might incur, let's see, we're 545. Looks like our market price on our in the money calls here, and we're going to roll up and only bring in $2 and change. So we're going to experience a debit on the front month roll, but that's going to be offset by the back month roll. So this whole adjustment is going to be done for a net credit. Okay, so this is the newly adjusted position. It shows a small gain, or not a small gain, but it shows a gain up here. So that's factored in as this position evolves. So we're still at the first adjustment point of January 19. We're now at February 16. Similar thing happened. Market moved higher. Our front month short calls are going to be in the money. Most, if not all, of the time value is gone. It's time to adjust the position. Okay, so the note here says the profit adjustment is essentially the same, but with the front month options, I want to evaluate whether to sell the 170 out of the money contract versus the 160 in the money. So in other words, the market is in between strikes. One is going to provide me with better upside profit potential, while the other offers more downside protection. So if you're thinking that the market might pull back, you might want to sell a little bit in the money. If you're thinking that the market's going to keep rallying higher, maybe you want to go out of the money, give the market a little bit more room to move to the upside. One of the things I like about OptionView is the ability to superimpose risk graphs. I can put up both risk graphs and take a look at them. Okay, and you can see that the pink line is a more aggressive adjustment. It gives me more room for profit if IBM rallies higher, but I also have less room to accommodate a pullback. So the difference here is that I've got quite a bit more room if the market pulls back, and I get a little bit more room if the market rallies. So I get a little bit more profit if we get a continued rally, but I have quite a bit more cushion in a pullback. And just looking at this, for me, I would rather have the more room for the pullback, because I'm not picking up that much more. I'm still going to be making money in the more conservative position. I might make a little bit more money in the more aggressive position, but if the market reverses against me, I'm going to be much happier in the more conservative adjusted position. And sure enough, we did get our pullback, but we're still profitable in the position. And so then we can start taking a look at the next adjustment. Okay, and I've got delta circled on our July options. We're about at an 83 delta, I think. No, I take that back. I think we're in the 60s someplace. It's hard to see, but the upshot of it is that we don't want to roll this contract because we don't have enough delta in there. The only time you want to roll this contract to a higher strike is if you have more long delta than what you started with. Now, I also do not want to roll it back lower, because that's just going to put more capital back into the trade. So I just leave it. The question here on the front month is whether do I roll to the same strike that I was at, or do I want to roll out to the next month and then to a lower strike? And this is what the two risk graphs look like. So you pick the one that is most suitable for what you're trying to do with your portfolio. If you want to really maintain that positive delta, this brown line probably provides you with, a much more favorable positive delta type trade. The bright pink line gives you that more room for that downside move. But if we get a renewed rally, you're going to give something up in terms of upside performance. Okay. So we're ready for our next adjustment here. Okay, and it does look like the market rallied. And so we're going to be in the money on the short options. All right, so what this bubble says is that the 160 call, which is where we rolled to, is $4.37 in the money. Rolling to the May 160 call will generate a $1.90 credit. So we can just roll straight across and bring in a $1.90. The long calls have about an 85 delta, which is about where we started. So you don't want to move these. You don't want to move these long calls. All right. So if we were to roll up a strike to try to get at the money, we're gonna experience a debit, which means we're putting more capital in the trade. On the other hand, I don't want to roll this guy up higher to offset that debit. So I'm probably going to stay in the money. Bring in another $1.90 credit and see what happens. So this is what the adjusted position would have looked like. Right? Here's my short option. You can see where it's located because that's where the peak is. So that's that 160 call option. I'm not going to get that much upside participation. But if we rally higher, I'm still going to make more money. And I've got quite a bit of room to the downside if IBM starts trading lower. So IBM did rally higher. Yeah, we've got about a 94 delta, it looks like, on the back month. So I want to move this guy up higher, and I want to move this guy out to June and up higher. So that's what we start looking like now. So kind of the post-mortem on this guy is the buy and hold. If we bought January 3rd, it opened at $147.21, and on May 20th it closed at $170.16. You made $22.95 per share for a 15.6% yield. Okay, now opening at 147, in order to buy 100 shares, you would have been in $14,700. All right. With the modified covered right, what we did is we used about a 10 grand in our account equity. That was the starting account equity. And then on May 20th, when we closed the trade out, we had $13,680. So we made $3,680, which is 36.8% yield. And then this is the screen from that account showing that trade from January 1, 2011 to May 20, 2011. And so that's a 36.8% yield on that $10,000 account. And the lowest value was 10,000, so we didn't have any drawdowns. Max drawdown was 0. Return was 36.8%. Annualized return 96.7%. And there it is, blown up for you a little bit. Now, word of caution here: you don't want to invest your account in one stock. Just doesn't. I mean, that doesn't work, because it leaves you with an undiversified portfolio. But the purpose of this little trade reenactment is to kind of demonstrate the concept. Now, how many stocks do you want in your portfolio? Well, different people will have different opinions about this, but the bottom line is you don't want more stocks than you can follow and manage. So if you're comfortable managing 3 or 4 trades, that's great. So you might have 3 or 4 long-term type positions. Then you might want to have a couple of a couple of monthly income type positions, and an occasional short-term, spec type trade. Maybe you'd like to trade certain stocks or certain indexes directionally. So you do that, manage the monthly income, manage your long-term stuff. The long-term stuff, you're going to be a little bit more hands-off with. You're going to let the market move up and down. You're not going to sweat the small stuff. So you're going to basically take a much longer-term perspective on things. Shorter-term trades, you're going to be more aggressive in your management. So some considerations. Long call option, how much time should you buy? Well, a lot of that's going to depend upon where the implied volatilities are and what your perspective is for future market movement. Leaps might make sense if you are a long-term bull and you can pick them up at a very favorable implied volatility. If you can't get the implied vol you want, in other words, they're too expensive, buy a shorter term option. Now, in the example, we used a July option, I think, traded into May. You're not always going to want to do that, especially if the market has pulled back in value, because your deep in the money option may not be that deep in the money. And if that's the case, you're going to have more time value or more extrinsic value in that option than you might have originally planned for. And that means you now have theta concerns in your back month. And so you may want to either roll that option out and buy an option that's further out in time, or you might want to close the trade. When buying leaps, I want to minimize my exposure to extrinsic value in the leap. So I want to get deep in the money. I want to be like a 0.85, 0.90 delta. And I want to make sure that the implied volatility is at a level I'm very comfortable with. With the short call options, your choices are you can sell them in the money, at the money, or out of the money. You also have to consider when are you going to roll them. You don't want to wait, and I don't think you want to wait till expiration. In other words, this idea of holding them, hoping they're going to expire worthless. Anytime you find hope entering your trading plan, it's a bad trading plan. You don't want to hope for things. But you can certainly hold these short options until the week before expiration or even the week of expiration. Don't worry so much about the commissions. If your commissions are so expensive that they've become a factor in when you're going to roll your options, you might want to take a look at trying to find a more affordable commission structure. So I like to roll the options. Once we get within a week or so of expiration, I'm going to roll the options anytime their value drops to a level that they're no longer an effective hedge. Now, if they drop to a nickel, that's almost that is a no-brainer. If they're a nickel, just buy them back, close them out, sell something else. But what if they're 20 cents? Well, the question you have to ask yourself is why, what is that option, what purpose is it serving? Why am I keeping it there? And if it's just for kind of this dogmatic notion that you don't want to buy back options or you don't want to pay a commission to buy back your options, you might want to rethink that. Because you're probably going to be better off modifying the position, either rolling them out to the next month or rolling them to a different strike in the current month. So trade selection, should you use an ETF or an individual stock? Well, that's going to depend a lot upon you, your comfort level selecting individual stocks versus exchange-traded funds, your comfort level in terms of price stability, whether you're looking for what we call rich call premium or these fat calls. Individual stocks tend to have more volatility in them and tend to offer more in the way of a call premium. Not always, but as a general rule. Trade management decisions. When do you close a covered right? Well, I'm going to suggest to you probably want to have a stop. At what point do you want to get out of the trade? Now, what we talked about earlier in this presentation is this idea of always being in the market and just shifting from more aggressive to more conservative portfolio structures. And if that's what you want to do, that's fine. But when do you make the shift? So you got to establish these rules up from the outset. If you're going to say, well, I'm going to always be long the market, but I'm going to use a moving average crossover to tell me when to get defensive and when to be aggressive, that's okay. You can do that. But at some point, you should also have some criteria in terms of how much of my portfolio am I willing to give up as part of my trading strategy. Does it make sense to surrender 8% of my portfolio equity? How about 10%, 50%, right? A lot of people experience 50% drawdowns in these market crashes. And that's a lot of money to give up. Now, did they make some of it back? Well, they did if they stayed long in the market. They made some or all of it back. But that really is a hard way to do it. But think through these things before you put your money at risk. Because once your money's at risk, your decision making tends to be less sound. So you want to really think through this stuff. I like to back test ideas and ask myself, whether this really is going to be something that I'm comfortable living through. Also, trade management decisions. What's more important to you, your profit potential versus your downside protection? Sometimes you might, your predisposition might fluctuate. In other words, there might be times when you might want to be more cautious, have more downside protection than you do profit potential. But then there might be times when your bias shifts where you really want to go after the profits, understanding that you don't have as much downside protection as you once did. So again, think through this. And it's a good time for us to cover this material because it's the end of the year, and it's a good time for reflection, especially in terms of our financial objectives and plans for the next year. So portfolio hedging. Stops. No matter how sophisticated we get, the simple fact remains that our losses must be smaller and less frequent than our profits. With every trade, you probably should have a predefined exit point. And I'll even modify that to say, not probably, you should always have a predefined exit point. I can't think of an investment offhand where there's no point at which I would want to get out of it. I think when most of us buy an investment or get into a trade, we have some expectation for what the market is going to do in the days ahead. And if the market has proven that we were wrong in our outlook, it's probably time to get out of the trade, reevaluate the situation, and then reapproach the market on terms that are more favorable for us. So in addition to stops, we can also purchase insurance to protect our equity. I'm talking about long puts here. When the VIX is at relative lows, such as below 20, especially when it gets down to 10, which is about as low as it goes, it makes sense to add some long puts to the portfolio just to keep things safe. Protective puts versus calls. All right, there's a greater need for us to own protective put options because market moves to the downside can damage both long-term and short-term positions. And they can be faster, more vicious than upward moves. All right, so the idea of buying protective call options, it doesn't really make sense for several reasons. But the protective puts, the reason they're there is if the market sells off, not only are you going to have some of those negative deltas from the puts, but you're going to have that long vega too. So as the volatility expands, the implied volatility expands because people are scared and they're buying put options, you're going to own what they want to buy. And the implied volatility is going to increase the value of your protective puts. With the call options, not so much. It doesn't work the same. Long puts versus using a put calendar. Put calendar, especially an out-of-the-money put calendar, can give you negative delta and a positive vega as a downside hedge, but the put calendar is not going to give you effective protection against a significant market sell-off. It'll help in a market pullback, but if the market really cuts loose and sells off fast, the put calendar is not the tool you want to use. And this is an example of a put calendar spread. It was a February 08 put calendar. And we had a nice thump in the market. And the market just thumped right through. Right, so it's an out of the money, right? It's an out of the money put calendar. So the idea is if the market pulls back, we should be able to pull a nice yield out of this thing. The problem is that it really thumped. And instead of being an out of the money put calendar, it's now an in the money put calendar. And we'd be lucky to make any money. We'd be lucky not to lose money on this trade. So the put calendar, the out of the money, I mean, I'm not telling you don't do them, just don't be overconfident in their ability to hedge against the market sell-off. Same scenario, except instead of the calendar, we're just going to buy those puts. The calendar costs $15.80. These are some cheap puts that we're going to buy for $3.65. When you buy puts like this, they probably just expire worthless. That's what is going to happen most of the time. But then you get that sell-off, and now they're worth some money. So that's why we call them insurance. When you buy insurance, you expect never to use the policy. You expect your policy to expire worthless, providing you no benefit other than peace of mind. Same thing with these types of put purchases. You expect them to expire worthless, never giving you any benefit other than the peace of mind that if the market does sell off, you've got some protection there. Long puts are the most effective downside hedge. They're negative delta, but they're also long vega. The put calendar has a defined profit range, which is why it is not always the best choice for these portfolio hedge techniques. And as we just showed you in the 2008 sell-off, the market just blew right through that out of the money put calendar. Also, a put calendar can hurt you if those front month options, if the vol rises faster in the front month than it does in the back months. So your short put options start increasing in value at a rate faster than your back month option. Okay, and then from here, what we will talk about, and we'll talk about this more, in this coming year, but we've kind of reached the end for tonight, is incorporating monthly income to the long-term portfolio. Because what we've talked about so far in this session and in the prior session is the concept of adding short premium to a portfolio in order to decrease volatility. And there are ways you can do this without necessarily doing a covered call approach. I mean, a covered call is not the only way to sell premium. And the short version of it is that I think monthly income strategies have a role in the overall portfolio. That if you're willing to spend the time managing monthly income strategies, that there can be a net positive effect for the whole portfolio. But the key is not to trade them in a way that's going to damage your portfolio returns. But that is something we will explore more in the coming year. So thanks for bearing with me. I am going to produce these videos. I'm going to add them to our learning materials. And as always, the forum is there for your questions. And if there's anything I can do to help you better understand things, please go ahead, post there, and I will get to them as quickly as I can. And that'll be it.